Hi everyone, welcome back to Be Rich. It is Saturday evening. I hope you have had a wonderful Saturday. For those of you who had the day off, I hope it was good and productive. For those of you who had to work like me and Rupesh, I hope that you are satisfied that the week is over and you're looking forward to your Sunday. Saturday, before you get it out, I wanted to give some food for thought. A lot of you have been always asking me about discounted cash flow method of calculating, and I've always said it's very complicated and it really leaves a lot to ambiguity and doesn't really help you to come to a conclusion. Especially new investors like you and me will find it very hard to use this. So today I'm going to give you a shortcut. This is in the series which I've been doing every weekend about asset allocation we spoke and how you should do your own analysis. So today we're getting into the nitty-gritty of actually looking at some stocks and seeing if a stock is at value or not. Because we've done all this asset allocation and everything, now we've got on to doing the the groundwork of actually buying these shares. So one of the fundamental analysis we beginners use is something known as PE, which is price to earnings. Anand has spoken about this, that historically if you look at the Nifty's median, it's at 20, and if the Nifty is trading above 20, then we say the Nifty is overpriced. If the Nifty is trading below 20, then we say the Nifty is at discount, meaning it's cheap. And usually we use the Nifty as a broad gauge, what we call analysis for the entire economy, saying the Indian markets are cheap, the Indian markets are expensive. So we use this Nifty PE. But we're not buying passively into Nifty. Yes, we can do that. But we're trying to become more astute and more seasoned investors, and we want to get into buying individual companies. So if you look at, let's say, like a sector like FMCG, we have ITC, you have Tata Consumers. And if you see the ITC PE is at a certain multiple, and Tata Consumers is a much higher multiple. And we're often left wondering why. They're both in the same sector. They're both selling products which are similar to each other. Both are selling atta, pulses. And you can expect a difference marginal, but sometimes a PE, one is at 20 odd and the other is at 60, 70 odd. You're left perplexed why. Most of the reasoning for that is given to us that Mr. Market feels that ITC today, let's say it's earning 10 rupees. Next year it might be earning only 11 rupees. So it prices that forward earnings in, so it is willing to pay a little bit more. In the case of Tata Consumers, Mr. Market thinks today it's earning 10 rupees. Next year I expect it to be earning 14 rupees. So, I'm pricing that in. And so today I'm willing to pay more for it because of what is going to be earning tomorrow. And why? If we ask that, we could give all kinds of justifications. But that really doesn't help us to analyze if the stock is at value today. We of course can look at the median, which is one way of looking at it, which is the first level, basic level. But we want to level up our game, right? So in this level upping the game, I'm going to teach you a little shortcut method of doing discounted cash flow. And you can use this very easily. And it's very easy to apply. You don't need to know too much accounting. You don't need to know too much of maths. It's a very simple equation. I'm sure Rupesh will put it up on the screen right now. Then I'll get into explaining about this equation. There's a couple of things which are there in this equation. We're going to try and calculate what we think the price to earnings should be. Forget what the market is saying the price to earnings is. What we need to find out is the price to earnings right now fair? Is this fair in the sense that is it based on the expected profits? Is it fair based on the expected growth, we think? And is it fair on the returns we are putting money, the cost of the equity? Meaning, we are investing our money, right? Like you go give your 100 rupees to the bank and it's giving you 6% interest. The return on equity is 6% and the risk is low, so they're only paying you 6%. But when you take that same 100 rupees and you put it in a stock, you are exposing yourself more risk into that business, so you should be expecting higher returns. So you may be expecting maybe 10%, 11%, whatever percentage you want, you can put that percentage. The other thing is growth. Growth is year on year. This we can look at the balance sheet and we can find out how much earnings is being growing, profits have been growing year on year, and that will give you a percentage. And that percentage is very useful. So that we can get from the balance sheet. Another thing which is important to know is the company makes profits after tax and everything's been put aside. Before the dividends is paid, it takes some of that portion of that money and it reinvests it in the business. Meaning it can be a capital expense or whatever. It takes a portion and is reinvesting in the business to make more money in the following year. That portion it's keeping and not paying as dividend is also important, because a portion as an investor you're giving up for future returns. So that portion of profits it's reinvesting, that we can also find out in the balance sheet. So growth to earnings we can find out in the balance sheet. Portion of the profits they're reinvesting in the business we can find out in the balance sheet. The only thing which is left is cost of equity or returns, what you're expecting. That is purely up to you, what you expect it to be. That is where the ambiguity comes in this equation. What do you think your cost, your return on the 100 rupees you're spending on this should be, is what you should look at. So if you look at the equation, to calculate what you think the price to earnings should be is 1 minus portion of the profits which the company has reinvested, which is not paid out as dividend, divided by the cost of equity, which is the return the investor is expecting, 10% or whatever percentage you think is fair, and that minus the growth rate in earnings, which you can calculate. That equation should give you the PE of what you think the PE should be. So let's do a simple analysis. For an example, we have company 1, 2, 3. I'll ask Rupesh to put this chart up on the screen as I walk through it. First, you have net earnings for each company is the same, 10, 10, 10. That is what their net earnings are. So we start with the same. Each one is reinvesting out of the 10 at different amounts. The first company is taking 3 rupees and it's in reinvesting it. The next one is taking 3.6. The last one is taking 4.4. Given to the shareholder is 7, 6.4 and 5.6. So return on investment is 15%, 18% and 22% respectively. And the growth rate, what we can calculate is 4.5, 6.5 and 7.7. This growth rate is, of course, we have given assumptions into. So all three companies start with a profit of 10, right? They each invest some part of it and given the rest to the shareholders. And the company with a higher return on reinvested money is growing faster. So company 3, the last one, is the one which is growing the most. So this is the way you can look at any sector and analyze it. So when you get this PE number, what do you do with this, right? One, we can look at different companies. Like I said, you can look at Tata Consumers, you can pour over the balance sheet, get these numbers, and you can look at the return and you can work out the PE. Once you've gotten this PE, what you think the PE should be, then you compare it to what the PE the market is paying today. And that will help you analyze to see if the market is paying too much for it or if it's paying too little for it. Because if the PE which you have calculated is more than the market PE, then the market is undervaluing the stock. So forget the median and all this, right? So you've calculated using this shortcut method. Let's say you calculate for Tata Consumer, your calculated PE is, let's say, 80, 90, and the market is right now paying 70. That means it's being discounted. Same way, let's say your calculated PE is less than the market. Let's say for Tata Consumers, you have calculated this and you come at a number of, let's say, 23 or 30 and market is paying 60, then you say, whoa, it's too expensive for the money which you're putting into this. This is one of the ways you can calculate what PE you think should be paid to the same stock which is currently being traded. This is another way of deep diving into it, getting into one more layer of analysis. Of course, the first layer of analysis is saying, historically the average PE is X the last 5 years, and now the market is buying it at X PE. Is it worth it? If you want to get into the more of the nitty-gritties, into the grapevines, as I say, then this is what you can do. So try and calculate some PEs and tell me what you arrive at. I'm curious to know what you come in terms of ITC or Tata Consumers, whichever company you want to pick. I'm sure a lot of you have your own favorite companies which you have not there in our list. It is not something we have spoken about. So pitch it to me. Say, hey Vinod, have you read about this company? I calculated with this method, your shortcut method, and I arrived at a PE of this, right? I'm expecting an equity return of this. This is what I've assumed. And the market is currently paying this. Do you think this is of value or do you not think this is of value? Throw that in the comments. I would love to read it. Same way, you can catch me on Instagram on the group and you can drop a note over there, and I'll be happy to read that too over there and have a discussion. There at least we can interact and have a two-way discussion. So that'll be interesting. So if you have missed these equations, you can go back and pause it. Otherwise, I'll ask Rupesh to put images of files down below, so you can download the image file and you can spend some time really looking at it. I hope you found this video informative and entertaining as always. I wish you a wonderful Saturday evening. I've given you some food for thought. I hope this is something which is of interest to you. If it was, please like and share and subscribe, and share with friends and folks who might find this interesting. Nothing more else to say other than have a wonderful evening. See you tomorrow, Sunday evening, before we get into the week again. Have a wonderful evening. Bye.